You've drawn the line. Price bounced off it 3 times. It looks perfect. Textbook support. You buy the 4th touch, and then price cuts straight through it like it was never there. No hesitation, no bounce, just a clean break and a growing loss. That wasn't a bad level. That was a weak level. And in this video, I'm going to show you exactly how to find the strong ones. Not with indicators, not with guesswork, with the actual mechanics that make a level hold or fail. Not financial advice, just education. Let's get into it. First, let's destroy the most common mistake. You were taught that the more times price touches a level, the stronger it is. Every course repeats it. Every beginner believes it. Here's the problem. Every touch consumes liquidity. The first bounce is strong. There are resting orders there, stops, limits, real participation. The second bounce is weaker. Some of those orders were already filled. The third touch, even weaker. By the 4th touch, that level isn't strong. It's exhausted. More touches don't mean more strength. They mean less fuel left to hold. Here's the one idea that changes everything. A strong level is not about how many times price respected it. It's about how much unfinished business is sitting at it. Unfinished business means resting orders, stop losses that haven't triggered, limit orders that haven't filled, traders who missed the move and are waiting to re-enter. That is what makes price reverse. Not the line on your chart, the orders behind it. So the real question is never did price bounce here before. The real question is, are there still orders waiting here? Now let's break this down into 3 things that actually create strong levels. Thing 1, the origin of a big move. Find a candle or a cluster of candles where price moved sharply and aggressively in one direction. A large decisive candle with real momentum behind it. Now look at where that move started. That origin point is a strong level. Why? Because when price left that zone that fast, it means orders were sitting there waiting. Big orders. Institutional size. And here's the key. They rarely fill everything in one visit. When price returns to that origin, those unfilled orders are still there, waiting. That's why the level holds. The fuel was never fully consumed. Sharp departure equals strong return. Thing 2, the level price spent the least time at. This one is counterintuitive. Most traders look for levels where price consolidated, where it hung around, where it seemed to respect the zone. But consolidation at a level means orders were being absorbed slowly. Most of the liquidity was already used. The strong levels are the ones price touched and left immediately. Fast rejection, minimal time. Why? Because price left so quickly that the majority of resting orders never had a chance to fill. That imbalance remains. When price returns, those unfilled orders create the same reaction. Fast rejection again. The less time price spent there, the more orders are still waiting. Thing 3, confluence with a liquidity pool. A level becomes significantly stronger when it aligns with where retail stop losses are clustered. Just below a swing low, just above a swing high, at a round number, at an obvious prior high or low that every trader on every platform can see. Why does this matter? Because those stop clusters act as a magnet. Price is drawn toward them. And once it sweeps them, the mechanical selling or buying that triggers creates the reversal fuel. A strong support level sitting just below a major stop cluster isn't just a support level, it's a collection point and a launch pad at the same time. Now here's how to separate strong from weak in real time. 3 filters. Before you mark a level, run it through all 3. Filter 1. Did price leave this zone with urgency? Large candle, fast departure. Minimal wick hanging around. If yes, the level has origin strength. Filter 2. How much time did price spend here? The less time, the better. If price touched and immediately reversed, that's the signature of unfilled orders. If price consolidated for hours at this level, most of the fuel is gone. Filter 3. Is there a liquidity pool nearby? Check just beyond the level. Are there obvious swing points where retail stops would cluster? If your support level sits just above a zone of clustered stops, price sweeping those stops and reclaiming your level is one of the cleanest setups in the market. All 3 filters passed? That is a strong level. 1 or 2 missing? Mark it, but reduce your conviction. Here's the mindset shift. Stop drawing levels where price bounced. Start drawing levels where orders are likely still waiting. That change in framing changes everything you see on a chart. You stop seeing lines. You start seeing zones of unfinished business, some loaded, some empty. Price doesn't respect your line because you drew it. Price respects a zone because there is real participation sitting there. Unfilled orders from a fast departure, a liquidity pool nearby ready to be swept. Minimal consumption from previous visits. That is what creates the reaction. The next time you're about to mark a support or resistance level, don't ask how many times did price bounce here. Ask why would price reverse here again? If the answer is there are still orders waiting, that is your level. If the answer is just that it bounced before, delete the line. Drop a comment. Which of these three things changed how you see your chart? The origin move, the time spent, or the liquidity confluence? I read every single one. I'll see you in the next video. Stay disciplined.